Well, third quarter earnings season kicks off, giving investors a little bit more food for thought amid growing conflict in the Middle East and the higher for longer interest rate debate and political instability in Washington. Our next guest says he doesn't think that this is the time to throw in the towel on risk assets, however, and would rather use this as an entry point again. Joining us now, we've got Max Kettner, Chief Multi-Asset Strategist at HSBC. So explain some of the logic to us just out of the gate here.
Yeah, look, I think, as long as growth expectations globally of some of those global major economies, let's say the US, the Eurozone in particular, as long as that continues to be really, really low, it's actually pretty good, right? That sets us up for a pretty low bar to beat from a top-down perspective. And you guys have been talking about the earnings season. And I think when we look at the expectations, we look at consensus expectations for the S&P. Look, consensus expects earnings to grow from Q3 to Q2 by around 2%, right? And most of the downward revisions that people have made in the last couple of quarters have really been on the cyclicals, right? They've been on consumer discretionary, energy, financials. They've been on things like materials, right? So they've been pretty sizable downward revisions, particularly in those cyclical sectors. So I would say, as long as you've got this underlying pessimism, both in top-down growth expectations, but also in bottom-up expectations, this is not an environment where you want to be really sort of listening to every headline and become suddenly bearish on risk assets overall.
So Max, with that in mind, then I guess investors out there looking to put money to work in terms of timing, should they be worried about the timing of the market and where they're putting money to work? Where are some of the most attractive opportunities right now?
Yeah, look, I think the US looks pretty decent, right? The US equity market overall, particularly the large caps, right? I do think energy still looks pretty attractive, right? When we look across other asset classes as well, or other regions, I think Latin America still looks really, really good. It's got these value characteristics. You're benefiting from that structural nearshoring, friendshoring story, but you're also benefiting from a bit more sort of value and commodity exposure, right? It's got a lot of energy, materials in there, but also the banks. When we look at other equity markets as well, the UK equity market, it's got these defensive value characteristics, right? It's got a bit of commodity exposure, but it's also got the healthcare, the consumers in there. Consumer staples, it's got probably a bit more of a tailwind from the weaker sterling now overall. So there are quite a few opportunities. I would also highlight in other asset classes, when we look at high yield credit still looks pretty decent, right? In the US, you get close to 9% yield with very low maturities going into 2024, right? So it doesn't really set us up for a massive default wave that may potentially come in 2025. But for the next couple of months, we should be still fine, right? And that actually leaves high yield credit also in a pretty attractive spot.
Where does this strategy or thesis rely or bring in some of the rate policy and where that may move globally in the next few months?
Yeah, look, I think we're sort of flip-flopping around, right, between Goldilocks and what we call at least reverse Goldilocks. So either this environment where things are looking not too hot, not too cold, right? And things are actually pretty decent and certainly better than those consensus expectations that I've just referred to in the beginning. And then the opposite is a little bit what we've seen in September, right? That's the environment usually where you're saying, actually, nothing performs, right? All that you've got to do is going back into cash and long dollar and pretty much sell everything. And I think, we're going to be flip-flopping around between those two for the foreseeable future, certainly for the next couple of months. It does rely, I think, on the Fed not becoming overly more hawkish than the market is pricing, at least for the next sort of 2 to 3 meetings. So we don't see another Fed rate hike. I don't see a particularly great attraction for the Fed to hike further. I think what they want to, really tell the market much more is that that rates will have to stay at these or at least pretty similar levels for quite some time, rather than keep on hiking, right? Really saying, look, it's going to take a little bit of time until consumers really feel the strain, until corporates really feel the strain. And the solution to that isn't really hiking rates much further. The solution to that is keeping rates at or at least at similar levels to right now for the foreseeable future, And with regard to that, that doesn't really affect our view too much, because what we've got to realize is that it's not really the level of rates, and in particularly not the level of real rates, that has affected, for example, equity multiples in the last 3 years. It's really been the volatility of interest rates that has affected multiples so negatively in the last couple of years. So as that interest rate volatility goes down, that in fact should actually be quite good for multiples.
All right, Max Kettner, always great to get your perspective here. Thanks so much for weighing in this morning. Chief Multi-Asset Strategist at HSBC.